It's Wednesday evening and you're staring at your bank app. Not because anything alarming happened, because something didn't happen. Again, the balance looks more or less the same as it did last month and the month before that, despite the fact that you've been working full-time for years and haven't done anything obviously stupid. You make real money, you pay your bills, you're not living extravagantly, and yet, the financial progress you expected to see by now, the savings cushion, the investment account that's actually growing, the feeling that you're slowly getting ahead, just isn't there. Here's the part nobody tells you. That feeling isn't an accident, it's an outcome. And the gap between where you are and where you thought you'd be isn't the result of one bad decision. It's the result of dozens of small, ordinary, completely invisible decisions that were never really decisions at all. They just happened, and they're happening again right now on autopilot while you watch. Today, we're going to name them, all of them, and more importantly, we're going to talk about what the people who actually close that gap do differently, because it's not what the internet wants you to think it is. Here's the foundational thing you need to understand before any of this makes sense. There is an entire system, sophisticated, well-funded, backed by billions in behavioral research, built specifically around extracting money from people who don't see it happening. The car industry doesn't show you the total price, they show you the monthly payment. The subscription economy is engineered to be forgotten. The gym signs you up in January knowing you'll stop going by March and keeps billing you anyway. These aren't oversights, they're business models. They work because they operate just below the threshold of conscious attention. Each individual charge is small enough to feel harmless. The aggregate, over years, is the difference between retiring with options and retiring without them. A major survey of over 10,000 millionaires found that the vast majority inherited nothing. Their wealth came from one thing: consistent saving and investing over a long period of time. Not stock picks, not side hustles, not financial complexity, just the boring, unsexy accumulation of redirected dollars that most people let drain away without noticing. Two people, same salary, completely different outcomes. Here's what separates them. Transportation is the first place ordinary people lose extraordinary money. A new car loses roughly 20% of its value in year one. On a $48,000 vehicle, which is near the current national average, that's close to $10,000 in depreciation before you've put 15,000 miles on it. Not because anything broke, just because you drove off the lot. A 3-year-old version of the same car has already absorbed that hit. You buy it at a fraction of the original price and get the majority of its useful life. The person who sold it to you funded the expensive first chapter. You get the rest for less. The monthly payment gap between a new car and a comparable used one is typically around $200 to $250. That might not sound significant, but $230 a month invested at 8% annual return over 30 years is over $330,000 from one car decision made repeatedly. And here's the thing that almost no one does: keep the car after it's paid off. The moment your loan is gone, your payment doesn't have to disappear. It can just change destinations. Redirect that same amount into an investment account, and your car, which you already own, starts building wealth instead of consuming it. Modern vehicles, properly maintained, routinely last 200,000 miles. The pressure to upgrade before then isn't coming from the car. It's coming from an industry that profits every time you upgrade. Housing is the second place. Banks will approve you for housing costs up to 40 to 50% of your gross income. Most financial planners say to stay at or below 28%. On a $95,000 salary, the difference between those two ceilings is over $500 a month. Over 30 years invested, that's around $600,000 in traded wealth, exchanged for slightly nicer countertops and a commute that's 8 minutes shorter. The other housing mistake that quietly costs fortunes is moving every 5 years. Every time you sell and buy, you absorb 8 to 15% of the home's value in friction: agent fees, closing costs, inspections, moving expenses, and the inevitable list of things the new place needs. The family that buys once and stays has a fixed mortgage payment while their income grows. Every year, housing costs become a smaller percentage of what they earn. That's a built-in raise that requires no negotiation, just the decision not to move. Here's the part the financial media spends the least time on because it makes terrible content. Independent research tracking investor behavior over 30 years found that the S&P 500 returned roughly 10.6% annually over that period. The average equity investor investing in the same market during the same period earned around 7%. Same market, completely different return. The gap isn't explained by picking bad stocks. It's explained by behavior. Buying when optimism peaks, selling when fear spikes, and missing the recovery that follows. The best trading days in the market's history have consistently clustered right next to the worst ones. Investors who sit in cash waiting for things to settle down reliably miss the rebounds that determine long-term returns. The habit that actually builds wealth is buy a low-cost index fund, S&P 500, expense ratio under 0.1%, set up automatic monthly contributions, and do not touch it when the market drops. That's it. It's genuinely that unglamorous, and the evidence for it is now 4 decades deep. The most powerful vehicle most people are ignoring is the HSA. If you have access to a high-deductible health plan, an HSA is the only account in the U.S. tax code with a triple tax advantage. Contributions reduce your taxable income, growth is tax-free, and qualified withdrawals are tax-free. Most people use it like a medical debit card. The people who invest those funds inside the account and leave them alone are sitting on one of the most efficient wealth-building tools available to any working American. Even if you get all the big structural decisions right, there's a second layer. It's quieter, more diffuse, and in some ways harder to see. The average American household unknowingly overspends on subscriptions by roughly $130 a month. They think they're paying $85, they're actually paying over $200. These charges land on different dates across different cards in amounts small enough that no single one triggers attention, but the total is a leak that runs year-round. Impulse spending costs the average household around $5,400 a year. Nearly half of social media users report buying something impulsively after seeing it on a platform. The behavioral mechanic is documented. The emotional reward peaks during the wanting, not the having. The item arrives and feels anticlimactic within days. The 24-hour rule, waiting a day before any unplanned purchase over $50, eliminates a significant portion of this spending without requiring willpower, just a pause. Food away from home now accounts for more than half of what American households spend on food. A home-cooked meal costs roughly a quarter of what a restaurant meal costs per person. Shifting even 20% of current dining out back to home cooking frees up $2,000 or more per year in most households, money that was already earned, already taxed, and currently being handed to someone else's business. Some of the biggest wins aren't about spending less, it's about claiming money that's already allocated for you. Your employer match. 1 in 4 employees doesn't capture their full 401k match. Collectively, American workers leave behind roughly $24 billion in unclaimed matching contributions each year. The average unclaimed amount per person is over $1,300 annually. That's a 50 to 100% guaranteed return on your contribution the day you make it. There's no investment in the world that offers a guaranteed return at that level. If you're not contributing enough to capture every dollar your employer will match, the single highest return financial action available to you today is fixing that. Negotiating your salary. Research consistently finds that the majority of employers expect negotiation and build room for it into initial offers, yet most job seekers accept the first number. A $5,000 difference in starting salary, compounded through raises and retirement contributions over a 40-year career, can represent hundreds of thousands of dollars in lifetime earnings from a single 5-minute conversation. The uncomfort lasts 60 seconds. The compounding runs for decades. Medical bills. Almost no one negotiates these. Almost everyone can. The price on a hospital bill is not a fixed-price transaction, it's an opening position. Insurance companies routinely pay 40 to 60% of list prices. Cash prices are often lower than insured prices. Simply calling the billing department and asking about financial assistance programs, payment plans, or cash pay discounts produces meaningful reductions for roughly half the people who try it. The only people paying full sticker price are the ones who don't know the conversation is available. One final thing, and it's the most important. Research on high earners finds that 40% of households earning over $300,000 report living paycheck to paycheck, not because they lack income, because spending scales perfectly with income every single time. The raise lands, the apartment upgrades, the car upgrades, the restaurants get slightly nicer. 3 months later, the margin is exactly what it was before, just at a higher number. The behavioral mechanism has a name: hedonic adaptation. Every improvement becomes the new baseline within months, and then you need the next improvement to feel like you're ahead. The income that was supposed to build freedom ends up building a slightly more expensive version of the same financial pressure. The fix isn't complicated. The day your new salary starts, increase your savings contribution before the money hits your account. What you never see, you don't spend around. What moves automatically doesn't get redirected to something that felt urgent on a Thursday. The person building real wealth isn't usually the one who looks like they are. They're driving a paid-off car, living in a house that's more modest than their income would suggest, and watching a growing gap between what they earn and what they spend close slowly, steadily, invisibly in their favor. The options that buys, to leave a job, to take a year off, to say no to something that isn't right, that's not visible from the outside. Neither is the $1.5 million index fund sitting behind it. There's no trophy for the car payment. Nobody applauds the subscription renewal. The system runs quietly and consistently in the direction of whoever built it,